What is hedge accounting? I'm Sylvia of cpdbox.com, and here I'm gonna show you not only what it is, but you will learn how to apply it on a simple illustration. First, we will see the accounting without hedge accounting, then with hedge accounting on a same example with derivative, and then we will compare to see the difference and why you should do it. So let's explain first. Imagine you have a producer whose functional currency is euro, and let's say that this producer finds a customer in the United States and agrees to sell goods for 11 million US dollars with payment expected in 6 months. The functional currency of a customer is US dollar. And so here we have a high foreign currency risk because the payment will happen in 6 months. So the producer decides to protect against that risk and enters into a foreign currency forward contract with the bank to sell 11 million US dollars at the rate of 1.10 US dollars per euro after 6 months. So effectively, whatever happens with the foreign currency rates in time, the producer fixed that rate at 1.10 now. After 6 months, a producer receives 11 million US dollars from a customer, and in line with the foreign currency forward contract, it pays 11 million US dollars to the bank and receives 10 million euros from the bank, which is the rate of 1.10 as agreed. So here you can see how that forward contract helped to manage the foreign currency risk because producer fixed the rate in advance. Now, this is hedging, but what is hedge accounting? The definition says it is designating one or more hedging instruments, well, in this case, the foreign currency forward contract, so that their change in fair value is an offset to the change in the fair value or cash flows of a hedged item, or the item exposed to some risk. So in effect, we have two items here. Hedged item. This is something that carries risk, for example, forecasted sale or purchase. And in this short illustration, it is clearly highly probable forecasted sale because it carried foreign currency risk. The second item is hedging instrument, and this is a derivative or maybe some other instrument that offsets the risk on hedged item. Well, that means that if we have a loss on hedged item, then we will have a gain on hedging instrument or the other way around. In our illustration, hedging instrument is a foreign currency forward contract. So we can have 3 categories of hedges: fair value hedge, cash flow hedge, and hedge of net investment in a foreign operation. But here we will focus on cash flow hedge because that's the most common type in the case of foreign currency risk. You can sometimes do the fair value hedge too, but let's do the most common thing here. Cash flow hedge is a hedge of exposure to variability of cash flows that could affect profit or loss. So in this case, we do not want variable cash flows. We prefer to fix them for budget reasons or whatever. How to account for those hedges? Well, we take care only about the hedging instrument here, and any change in its fair value, either gain or loss, splits to 2 parts: effective portion, and that is recognized in other comprehensive income, and this is called cash flow hedge reserve, and then it is recycled in profit or loss whenever hedged item affects profit or loss, or it's also included in the cost of hedged asset or a liability. No worries, we will show the exact journal entries here in this video. Ineffective portion is recognized in profit or loss. And so you see here that normally you would recognize the full fair value gain or loss on derivative in profit or loss, but not when you apply hedge accounting. Now, I teach all about hedge effectiveness, splitting into effective and ineffective part in the IFRS kit, so maybe you'd like to check that out for more details. For now, let's stick with basics and see the example. So we have a transaction expected sale of 11 million US dollars in 6 months, and the functional currency is euro, so this is a foreign currency transaction, highly probable. The start date is 1st December 2004, and the sale together with payment are expected 6 months later, that is 31st May 20x5. For simplicity, let's say that payment and sale happen on the same date. To protect against foreign currency risk, we enter into the foreign currency forward contract to sell $11 million at the rate of 1.10 US dollars per euro on 31st May 20x5. Now, fair value of forward is a gain and fair value of anticipated sale is a loss. That's a nice offset here of 150,000 euros at the end of 20x4. And again, for simplicity, let's say that there is no ineffectiveness. Finally, the spot rate at sale on 31st May 20x5 is 1.15 US dollars per euros, and we will treat it as a cash flow hedge. So first, let's draft the journal entries as if no hedge accounting is applied. At the year end, which is our reporting date, we need to recognize fair value change of the derivative in profit or loss. So we debit derivative assets and credit fair value gains in profit or loss with 150,000. The question says that we have a gain on derivative. And this is the standard treatment as required by IFRS 9 for derivatives in general. Now, at the time of sale, let's assume that the sale really happens, but here we do not apply hedge accounting, so we just care about the derivative. Let's revalue the derivative first. So we need to calculate its fair value at the expiry or sale date. So if we would need to sell 11 million US dollars at a spot rate of 115, that we would receive 11 million US dollars divided by that rate, and that is 9,565,217. However, we have a contracted forward rate. So we will receive 11 million US dollars divided by that rate of 110, and that is 10 million euros. So our contracted forward rate is more beneficial because we are receiving more euros for 11 million US dollars than at the market spot rate. And therefore we have a gain here of 10 million less 9,565,217, which is 434,783 euros. But we have recognized a part of that gain of 150,000 in 20x4. So now we just recognize the difference of 284,783. We debit derivative assets with that amount and credit fair value gains in profit or loss. And then we also need to recognize the settlement of the forward contract with the bank. So let's do it gross, but it depends on the contract. We debit bank accounts with 10 million euros. That's what the bank pays us. We credit bank accounts with 11 million US dollars at the spot rate of 115. That is 9,565,217. And we also derecognize or remove the derivative asset of 434,783 euros. So our entry is balanced and the derivative is settled. And then, of course, you would recognize a regular sale transaction at the spot rate. Now, let's see the journal entries when we apply hedge accounting to the same transaction. And of course, after meeting all the criteria and conditions. So at the year end, we debit derivative assets with 150,000. And this time we credit other comprehensive income, cash flow hedge reserve, because remember, this is a cash flow hedge and there is no ineffectiveness for simplicity. So nothing goes in profit or loss. Now, after 6 months at sale, we need to perform 3 journal entries. 1, revalue hedging instrument or derivative to its fair value. 2, account for the settlement of the forward contract. And 3, recycle cash flow hedge reserve because the sale happens and the hedged item affects the profit or loss exactly at that point. So 1, we debit derivative assets, and again, we credit cash flow hedge reserve with 284,783, and the number is exactly the same as we calculated before, so I'm not going to repeat that calculation here. Number 2 is just the same entry as before with no hedge accounting for settlement of the derivative with the bank. So we debit bank account with 10 million, we credit bank accounts with 11 million US dollars at the spot rate of 115, and we also derecognize the derivative asset in full. Finally, number 3, we debit cash flow hedge reserve in full, and we credit revenues from sales in profit or loss. See, here the hedge accounting makes it possible to adjust sales revenue, not like before without it. Do not forget to recognize a regular sale transaction at a spot rate. Now, moment of truth. Is the hedge accounting worth the effort? Should you do it or not? Well, let's compare the results. When we did not apply the hedge accounting, so no admin work, our profit or loss looked like this. So these are only the numbers related to the transaction. So in 20x4, you had some fair value gain, and in 20x5, you also had a part of that gain, plus those sales are recognized at the spot rate at sale. When we did apply the hedge accounting, here are the results. Zeros in 20x4 and in 20x5, all is reported as sales, even that gain from the derivative. So what does that mean? First of all, gains or losses, well, gains in this case, from the derivative are held in other comprehensive income and then shifted and reported in the same period when the hedged item affects profit or loss. Here, anticipated sales became reality in May 20x5, so gain from the derivative was reported exactly at that point. Also know that gains from derivative are shown together with sales, not separately as some financial result. And thus, in fact, you are showing the risk management instrument together with the risk managed. In other words, you are not showing your derivative as some speculation or whatever, but as risk management. So yes, hedge accounting shows the risk management nicely, and the sales are reported close to forward rate. But on the other hand, it involves much more administrative work because there are conditions to meet. Please like this video if it helped, hit subscribe button and notification bell to stay tuned for more. Thank you!